Hello everyone, Jack Luttge, Mortgage Advisor here, and today we're going to do a class on mortgage basics. In this video, we're going to talk about where to get a mortgage, how to shop for a mortgage, different loan types, different definitions of words, lingo in the mortgage world that you need to know, and also fees and interest rates and how they work in mortgages. So let's get started. So first, who provides mortgage loans? Where do you get a mortgage? There are four primary sources to get a mortgage loan. One is banks, big banks, US Bank, Bank of America, PNC, even small banks. Most banks have a mortgage division and you can get a mortgage from there. There are also mortgage bankers. The difference between banks and mortgage bankers is that mortgage bankers or mortgage companies, they aren't necessarily lending their own money. They're not depository institutions. And most of the time when they originate a mortgage loan, they're not going to keep the loan. They're going to sell the servicing to a different company. But mortgage bankers or mortgage companies are typically a little bit faster with mortgage loans. They're easier to deal with. Banks usually have a little bit more red tape because they're too busy doing all the other things that involve banking. So banks typically, not always, are not very good at doing mortgage loans, but they do them. And mortgage banks or mortgage companies, they're usually a little bit faster and easier, especially on purchase loans. Mortgage brokers are third-party companies that basically broker out mortgage loans. So they are not, when you apply for a mortgage through a mortgage broker, you're applying to them, but they're going to do that loan with a different company, and they're going to take your application and they're going to shop several different lenders and get a loan through somebody else. The benefit there is if you're not sure about, how to go about getting the best deal, the idea of a mortgage broker is that they shop for you. They're shopping multiple different lenders, and they typically have access to lenders that you wouldn't have access to otherwise, giving wholesale mortgage rates. So that's the benefit of mortgage brokers. And then credit unions also do mortgages. And sometimes they have really unique, interesting programs that other institutions don't have. And their guidelines can sometimes be a little bit different. So those are kind of the four main sources of mortgage loans. How do you pick one? Number one, look locally. This is actually a really important thing, especially if you're looking to purchase a home in the current economy. It is very much a seller's market. And so sellers kind of are in the driver's seat, and you may be having to be in, situations where you're not the only one putting an offer in on a house, and you have to put a really strong offer forward. And this is where having a pre-approval from a local lender can be really beneficial, because big institutions that are not local, they have a reputation, a lot of them have a reputation for not being able to close on time, sometimes not being able to close at all, and things like that. Whereas a local lender is typically going to have a better reputation in the local economy, and realtors will know who they are, and they'll know that that pre-approval is actually a strong pre-approval. So that's the biggest reason that you want to look locally for a mortgage lender. Also, interview multiple lenders. Not everyone has the same fit. Not everyone kind of talks the same way, works the same way. You might find a lender that you really like, and there might be some that you don't like, and there's lots of reasons. There's lots of personality traits, things like that, but also different options that lender has. I mean, maybe you are looking for a lender that specifically works for first-time home buyers, or has different programs that other lenders don't have, things like that. It's important to shop around different lenders. I did not mean to do that. Yeah, evaluate loan officer response time. This is actually a really big deal, especially in the purchase market, where when you're under contract to buy a house, you typically have 30 days and you have to close in 30 days. And so timeliness is super important. Responsiveness is super important. So these are questions that you want to ask when you're shopping for a lender: is how quick they respond and how long is it going to take to process and underwrite your loan. These are important questions that you want to know. Now let's get into some key mortgage terms. So these are some lingo that your loan officer might throw around, and it'd be good for you to kind of have a basic understanding of what these words mean. That way, when they say these things to you, you're not just like, huh? So first off is loan to value. So loan to value is basically a calculation of how much you're borrowing on the house versus how much the house is worth. So a high loan to value would be like 95% loan to value. When someone says you have 95% loan to value or 95% LTV, that means that you're borrowing 95% of the value of that home. So like for simple terms, if you have a $100,000 house, you're borrowing $95,000 for that house. That's 95% LTV. 50% LTV is I'm borrowing $50,000 on a $100,000 house. So that's loan to value. Next one is debt to income ratio. So we're actually going to get more into that in the next video when we go through the pre-approval. But basically, your debt to income ratio is a ratio of your income, your full monthly gross income versus all of your outstanding debts. So the mortgage, your car payments, your credit card, student loans, anything that you have, all of that stuff put together, the ratio of that number to your gross income. All right, so that's debt to income ratio. Prepayment penalty. In the purchase mortgage world, these are pretty rare nowadays, but the concept of a prepayment penalty is if you would pay off the loan earlier than its maturity date. Say you get a 30-year fixed mortgage. If there's a prepayment penalty, there might be when you go to pay off the loan, there may be an extra fee that you have to pay if you want to pay it off too early. So that's a prepayment penalty. Now, like I said, most mortgage loans nowadays don't have these. You typically see these more in like commercial or business loans. But that is something for you to be aware of. If your loan officer mentions a prepayment penalty, it's important to pay attention to that. Points. We're going to get more into points later on, but points are basically an optional fee that you can pay to get a lower interest rate on your loan. And we're going to get more into that later. Loan term. When a lender talks about the loan term is how long the mortgage loan is for. So some common loan terms are 30 years. That's kind of the standard, a 30-year fixed rate mortgage. The loan term is 30 years. There's also 15 years and there's 20 years. Those are pretty typical loan terms. Rate lock-in versus floating rate. So mortgage lenders can, when you go to get a mortgage, there is a rate that's associated with that, right? But that rate, it can change at any point until you lock in the rate. Now, there's pros and cons about locking in, too early. Like if you're still like 30 days from closing, you might consider locking in your interest rate, and that basically protects you if like interest rates go up. You're protected, you're locked in at that lower interest rate. But there's also the consideration of when you lock in that rate, that's the rate you're getting, like it or not. That's the rate you're getting. So if rates do go down, you're not getting the lower rate. You're sticking with the rate that you had. So there is some strategy around locking in an interest rate or floating an interest rate for a certain amount of time. And then annual percentage rate, or APR. So this is different from your regular interest rate on a loan, because what an APR does is it takes the interest rate and all of the fees that you paid to get that interest rate or to get that loan, and encompasses them all together and gives you a kind of cumulative interest rate expressed as an interest rate, to kind of express the total picture of that loan, the total cost of that loan. So an APR is generally going to be higher than the regular interest rate because they're also including all of the fees into that number. Some more key mortgage terms. There's a lot of mortgage terms. Escrow account. An escrow account is a basically forced savings account that pays your property taxes and your homeowner's insurance at the end of the year when those bills come due. These are typically big bills, multiple thousands of dollars most of the time, that you don't want to get all at once. And so they created these escrow accounts, and they basically take the total amount of your homeowner's insurance and the total amount of your property taxes. They divide that number by 12, and they put 1/12 of that on your mortgage payment every month. So that way it kind of, you're paying it every month, and it saves that money until the bill comes due, and then they pay that bill. So that's an escrow account. Closing costs. Closing costs is all encompassing all the different fees that you might pay in order to obtain a mortgage loan. And we're going to get more into that later also. Down payment. Down payment is money that you have to put down for a house. And down payment and closing costs are two different things. And the down payment typically is going to be a percentage of the purchase price. You know, common ones is like FHA loans require 3.5% down payment. So on a $100,000 house, your down payment would be $3,500 because it's 3.5% of the down payment, or of the purchase price. I mean, prepaids. Prepaids are what basically pre-fills that escrow account that we were talking about earlier. They always want to have a little bit of a cushion of extra money in that escrow account in case when the bill comes due, it's higher than it was before. So they always take a little bit of cushion in there initially. And so that's what prepaids are. That's money that's going into the escrow account right when you close on the loan. Closing disclosures and loan estimates are both disclosure forms that your lender will give you that kind of tell you all the details of your loan, your interest rate, your monthly payment, all your closing costs, the terms of the loan. All sorts of helpful information are going to be on those forms. And I actually have an example of a loan estimate that we're going to look at here in a little bit. Amortization schedule. So this is basically, think of it like a calendar of the entire life of the loan. You know, on a 30-year fixed rate mortgage, you're making 360 payments. And every single one of those payments is going to have a breakdown of principal and interest. And your amortization schedule basically shows you each individual payment and how much is principal and how much is interest. And then PMI, private mortgage insurance. So PMI, or mortgage insurance in general, is an insurance policy that the bank takes out that basically protects them if you default on the loan. So this is an insurance policy that doesn't actually help you. This is different from homeowners insurance. This is mortgage insurance, and actually protects the bank if you default on the loan. If the house goes into foreclosure, think of it, it's kind of similar to like gap coverage on your car, right? If you get a car loan, and let's say you get a car loan and you finance the entire purchase price of that car, even like the extended warranty and, you know, the registration fees, like all of it, you just put it all on this loan. And so you've got a loan that's more than what the car is even worth. And then 2 months later, you get in a car accident and you just wreck the car. The car is totaled. Gap coverage, you know, insurance is only going to cover what the car is worth, right? And so what happens then, that now you all of a sudden, you still owe this extra money because you borrowed more than what the car was worth. Gap coverage covers that gap so that you don't have to, you know, pay out of pocket to pay off that loan. PMI is kind of the same thing for mortgages for your house. It pays the lender if you have to foreclose on the house, but the house isn't worth what the loan is. And so that's basically the concept around PMI. And it doesn't protect you in any way, but pretty much every lender and every loan program requires it if you're putting less than 20% down. Pretty much every lender. And they call it different things. This is a soapbox issue for me because there are a lot of loan programs out there that say they don't have PMI. And maybe they don't have PMI, but they'll have something else. They just call it something different. There's also MI, MIP, guarantee fees, funding fees. lender paid PMI or lender paid MI. Like there's all different names for it and different ways to structure it to where it hides it and they can tell you, oh, we have a loan with no PMI. They do have PMI. They're just calling it something different. If you're putting less than 20% down, you can bet you are paying PMI in one way or another. So, but it's unavoidable. If you're putting less than 20% down, you're going to be paying PMI. Okay, some different loan programs that are out there. So we have government agencies or government sponsored. So the first two on here, well, I guess first three, FHA and VA, are two different programs. They're just kind of administered by the same organization. I guess the USDA is too, actually, but all three of those are government entities. So these are government loans. They have, you know, their own set of criteria and requirements, but these are backed completely by the government. And then Fannie Mae and Freddie Mac are government sponsored. So they're not technically the government themselves, but they're pretty controlled by the government. And so all of those programs are government backed. And so they're pretty secure, they're pretty stable. They have very set requirements that you have to meet. And those are kind of like most first-time home buyers are going to be using one of those programs. There's also state agencies. So here in Missouri, we have a program called MHDC, which just stands for Missouri Housing and Development Commission. They have a mortgage loan program specifically designed for first-time home buyers. It's basically a form of down payment assistance wrapped into a mortgage loan. And that can be a pretty good program for some people. So that is a state agency, a different loan program that you can look at. There's also different assistance programs. There are down payment assistance programs like Beyond Housing, things like that. There's also portfolio loans through different banks. Most lenders have some sort of special program for first-time home buyers. And so it's always a good thing to ask if you're a first-time home buyer to call around different banks and ask them what their special programs are, because some of them can be pretty good. So those are things you want to be aware of. Here's some different loan types. So you have fixed rate mortgage and fixed rate mortgage versus adjustable rate mortgage. Fixed rate mortgage means it is a fixed loan with a fixed term, with a fixed interest rate and a fixed monthly payment. A 30-year fixed rate mortgage is the gold standard of mortgage loans and has been for 50 years. It is 30 years of fixed payments with a fixed interest rate. The principal and interest payment never changes. It stays the same for the life of the loan. Versus adjustable rate mortgages, where there's typically a fixed period, 3 to 7 years in some cases. And then after that, it adjusts. And there will be an adjustment rate, like it adjusts once a year or adjusts every 2 years or adjusts every 6 months, and it'll adjust to whatever the prevailing interest rate is at that time. So that's an adjustable rate mortgage. Then we also have revolving mortgages, also known as a home equity loan or home equity line of credit, HELOC for short. You may have heard of that. Those are more of think of it like a giant credit card backed by your house, secured by the house. It's this massive line of credit, sometimes $100,000 line of credit if you've got that much equity in your home that you can borrow from and pay it back. You can borrow it again, you can pay it back, and things like that. And then we have interest only or balloon loans. These are pretty rare. These are not very common nowadays, but an interest only loan is exactly what it sounds like. It's a mortgage payment with interest only payments. And typically those are balloon loans. Like typically an interest only loan will be a balloon loan because the way it works is it's interest only for a certain amount of time. Let's say 10 years or 20 years or whatever. It's interest only, and that can be fixed interest only, or it could be adjustable interest only. But the idea is you're making interest only payments for a certain amount of time, and then it balloons. The whole thing is due. When you hear of a balloon payment, that means the entire loan is due at the end of that term. So you basically have through that interest only period or through that period until the balloon to figure out what you're going to do with it. If you're going to sell the house, if you're going to refinance at that point, or if you're going to save up enough cash to pay it off. Those are your options. So that's a balloon interest only loan. All right, When you go to compare different loan programs, these are the important things that you want to compare. So when you're shopping different lenders and you're talking to different loan officers about the programs that are available, these are the things you want to know. You want to know how much of a down payment is going to be required. Is it 3%? Is it 5%? Is it 10%? Is it 20%? You want to know what the loan origination fee is. You want to know what the total closing costs are. Upfront costs and closing costs are kind of the same thing, really. You want to know what the interest rate is and the APR, and you want to know what your monthly payment is. And make sure that you ask them what your monthly payment is, inclusive of the escrow and any PMI. You want to know what the total monthly payment is, because they can quote you like a principal and interest payment, but that's not everything. You also have to think about escrow for taxes and insurance, and if there's any PMI or things like that. So this is a comparison of a couple different loan options. So this just illustrates the difference that your interest rate can make. So on a $194,000 30-year fixed rate loan, this is a very common loan. I write loans like this all the time. An interest rate of 5.99% is going to give you a principal and interest payment. Now, again, this is just the principal and interest. This doesn't include escrow for taxes and insurance or PMI. But on a 5.99% interest rate, your payment's going to be $1,161 versus a 6.99 payment. Your payment's going to be $1,289. That's $125 or $128 difference every month for a higher interest rate. And then look at the total interest paid up here. Look at the huge difference in interest that you're going to pay on that. If you can get a lower interest rate, it is such an important thing for when you're doing a 30-year fixed rate mortgage that you're going to stay in for a long time. You really want to pay attention to that interest rate and try to shop lower interest rate loan options. Okay, now we're going to talk about points. So points is basically a way that you can kind of pick your interest rate, sort of. So common thing that a lot of people don't know about is that your loan officer can actually quote you just about any interest rate they want to. It's just there's a point cost associated with any interest rate. So this is a rate sheet that I pulled up for just a random scenario. And these are old rates. These are not live rates. This is not a quote for anyone. This is just to illustrate the concept of points. So whenever your mortgage lender is quoting you an interest rate, typically what they're going to look for is the par rate, which is the lowest interest rate without charging anything. So here, the credit is actually expressed as a negative number. So all of these up here, these are money that you'd have to pay to get that interest rate, versus down here is actually a credit that you could get if you take that interest rate. So basically, as you can see here, like the par rate, which is the lowest rate without charging you anything, is 6.625. And that gets you a 0.398% credit, or $772 in this case. You could take a 6.99% interest rate, and you would actually get a credit towards your closing costs of $2,000. And maybe that's more important to you. Maybe you're not so concerned about the interest rate. You plan on refinancing very soon, and you just need to get, as little money to closing as possible. Maybe you're short on cash right now, but you have really strong income. That might be an option. Vice versa, you want a low interest rate, right? According to that slide before, if I'm going to be locked into this thing for 30 years, I want the lowest interest rate I can possibly get. You could get a 5.99% interest rate and pay $3,296 in order to get it. Or you could go somewhere in between. Maybe you meet somewhere in the middle. Maybe you take 6.375 and you pay $1,100 to get that interest rate. So that basically shows you, and here's the monthly payment that all of these, I don't know if you can see my hand very well, but you can see P&I right here. These are the monthly payments for all of these different options. So this kind of shows you, a lot of time a good mortgage advisor will try to show you how you can kind of figure out the break-even point. If let's say this 1.22, you're going to be paying $2,000 to get your payment at 1179 versus 1242. Well, how long does it take to recoup that upfront cost with that lower interest rate? So those are some things that you want to keep in mind. All right, here's some other closing costs that you might have. So you're going to have loan fees. So loan fees are going to have a bunch of different names. In fact, I think the next slide, yeah. So we have this whole slide here that talks about loan fees, different types of fees. So there's, and different lenders are going to have different fees, and some of them might not charge all of these things. You know, credit report and appraisal, those are pretty universal. Like you're going to have those anywhere. Credit report is, you know, the fee that they charge to get your credit report. It's pretty simple. Appraisal fee, same thing. So an appraisal is something that every lender is going to require. They're going to want an appraisal to make sure that the property is worth what you're paying for it. But all the rest of these, they vary from lender to lender, and they're going to call them different names, like a loan application fee, a processing fee, an underwriting or an administration fee, loan origination fee. All of these fees are basically the same thing. They are fees that the lender charges you in order to originate that loan. And they are using that money to pay, you know, they have people they have to pay to do things like their underwriters and their processors and their loan officers. Like everybody has to get paid, right? I mean, they're doing a job. So these are fees that they charge on the loan, but every lender's fees are going to be different, and they'll call them different things. So you need to be aware of that. So going back to this other page here, some other closing costs that you can expect: interim interest, also known as prepaid interest. So when you close on a mortgage, typically you're not closing on like the very end of the month. You're going to close sometime in the middle of the month, on the 15th or the 20th or the 25th of the month. And so that prepaid interest or interim interest is the interest you would pay on the remainder of that month for that loan. And then homeowners insurance, also known as hazard insurance. Homeowners insurance is something that you always have to pay for. You always have to have homeowners insurance when you're getting a mortgage for a house. They want to make sure that if there's a fire or a tornado or something like that, that the house is going to be protected and covered, and that their investment is secure. And so you do have to have homeowners insurance, and typically the lender is going to require you to pay your first full year's homeowners insurance in advance. There's also going to be escrow reserves. So like we talked about that before, that's the money that you have to pre-fill your escrow account with. And then there's going to be title fees, appraisals, and any mortgage insurance. Sometimes mortgage insurance will be collected upfront at closing as a closing cost. So these are some different closing costs that you might have on a different loan. So here is an example of a loan estimate. So this is an example loan estimate. Actually, FDIC puts this out there, and you can go to their website and you can look at this. But I pulled this up because I want to go through it with you guys and kind of explain what everything is on here, because there's a lot going on this form. It can be overwhelming to people. So we're just going to go through this and explain it. So you have up at the top, right where underneath where it says loan estimate, you have the date it was issued, applicants, that's going to be your name and your address, the property of the place that you're getting a loan for, and the purchase price. And then on the other column, you have your terms of the loan. You know, it's a 30-year loan, it's a purchase loan, it's a fixed rate, so it's not an adjustable rate. It's a conventional loan. That means it's either Fannie Mae or Freddie Mac. You also have FHA and VA as options up there. You have your loan ID number, and then you have the rate lock. So remember, we talked about locking versus floating. So this is actually really important when you're comparing these loan estimates from different lenders, because if that rate's not locked, that rate can change. You know, if the rate's lock says no, that means that you're still floating, and that rate can change. If something changes in the market before you lock in that rate, you know, that rate might be different. It could be higher, could be lower. So that's an important thing that you want to keep in mind. So then we go through kind of the loan terms, right? So you have the loan amount. You know, in this case, this person's borrowing 162,000. You have your interest rate, and then that gives you, those two numbers give you your principal and interest payment. So this is the portion of the mortgage payment. This right here, this principal and interest payment up here, this is the amount that never changes. On a 30-year fixed rate mortgage, this number stays the same for 30 years. Now, people like to say that when you get a mortgage, your mortgage payment never changes, and that's partially true. because this number never changes. However, this is your full mortgage payment. This is your principal and interest payment and your escrows, your escrow for taxes and insurance, and your PMI. So down here, you have the breakdown of your total monthly payment. You have your principal and interest payment, you have your PMI, and then you have your escrows, and that's your full mortgage payment. And then if PMI does go away, sometimes there'll be another one over here with PMI removed that shows you after 8 years when your PMI drops off, your payment will go down. So that's an important thing to remember. So this number will never change. This number will actually change pretty much every year as your escrows change, because your property taxes and your homeowner's insurance, they change every year and they typically go up. So don't buy into the lie that if you get a mortgage, your payment is never going to change, because it's simply not true, because your taxes and your insurance are going to change. All right. Next, down here, we have your estimated closing costs. So this is the total of all the closing costs, and that is actually broken down on the next page. And then here at the bottom, at the very bottom here, we have your estimated cash to close. This is the total amount that you're going to have to pay for this mortgage. This is a super important number. So like when you're shopping for a mortgage, you get loan estimates from multiple lenders, you're going to be paying attention to this number and this number. It's how much down, how much a month. That's what you want to know. How much down, how much a month. That's what you're comparing. All right. So let's get into the fees on the next page. So I like how they did this. They gave us lots of different options, lots of different examples of fees. And not all of these will apply in your specific case, but at least we can kind of talk about them. So if we start up at the top on loan costs under A, origination charges. So these are going to be fees that the lender charges for the loan, right? So you have some points on there. You have an application fee, an underwriting fee. There's going to be different fees with different names. They'll call them different things like admin fee or underwriting fee or processing fee or whatever. They're all basically the same thing. If they're in section A, those are lender fees. And those are something that you compare from one lender to another. And then in B, these are honestly kind of also lender fees, but they're not specifically paid to the lender. They're usually third-party fees. So like your appraisal fee, your credit report fee, flood determination fee, flood monitoring fee, tax monitoring fee, tax status research fee. Like there could be all kinds of different things in here, but these are fees that aren't necessarily going to the lender, but they are required in order to get the loan, and they're paid to a third party. So that's what section B is. Section C is services that you can shop for. So these are going to be mainly title fees. A lot of people don't realize that you can pick which title company you use. Most people don't. Most people just go with whoever, typically whoever the realtor likes is typically, the title company that gets chosen. But you can call around every title company in town and you can shop them, and you can say, here's my deal. I'm paying this much for this house. The loan amount is this much. What would you charge me to do the title work? And you can shop it around and you can find a deal, and you can do that. So those are title fees down there. There's other fees that might be involved, like a survey or a pest inspection, different things like that. Those are just different fees that you can shop for, and that's the difference between B and C. Is B, you can't shop for those. You can't shop around appraisers. You can't shop around credit report vendors or things like that. Those are set. But if it's in section C, that means you could shop it. You can find a better deal somewhere else potentially. Okay, on the other column, we have other costs up here on the top here. Taxes and government fees. This is typically going to be like recording fees. The title company, when you buy your house, they're going to record that deed and mortgage with the county, and they have recording fees. So you're going to have to pay those. And then depending on what state you're in, you might have transfer taxes. I know Florida has transfer taxes. Missouri does not have transfer taxes, but it just kind of depends. Transfer taxes is something that applies in certain states. And then prepaids. So these are the prepaid amounts that are paying your first full year's homeowners insurance. I don't know why they have 6 months on there. It's pretty much always a full year worth. But that's what that is. And then you have your prepaid interest in there. And then the next one down is your initial escrow payment. So this is the money that's going into that escrow account to pre-fill that escrow account. And that is a pretty typical amount there. They're going to want 2 to 3 months worth of homeowners insurance and 2 to 3 months worth of property taxes to initially fill up that escrow account. And then in H, there's other. And this is basically everything else. Owner's title policy is a pretty common one. So with your title work, they're going to have a lender's insurance policy, lender's title policy, and that protects the lender in case there's any kind of dispute or something happens with title on the property. You can also get your own owner's title policy, and I definitely recommend doing that. If you're buying a house initially, you definitely should get an owner's title policy. They're usually not that expensive. Like this one's $1,000. The ones I've seen lately are anywhere from $100 to $300 or so in most cases. And it's definitely worthwhile because what an owner's title policy does is it protects you if someone comes along and tries to claim that house. This can be maybe a contractor who had done work on that house in the past and never got paid. It could be an old heir who was supposed to inherit that house and never got it. There's lots of different reasons why someone might come and try to lay claim to the property. And this insurance policy, once you've got it, it's good forever. And anytime someone comes knocking on your door and saying, hey, I actually am owed money on this house, you just send them to your title company and you don't have to think about it anymore. So definitely worthwhile to do that. Okay, so then you have at the very bottom here, I'm going to move my head so you can see this a little bit better. We have the total of the cash to close, right? And it kind of shows you the closing costs, down payment money. If you've made a deposit already, that can be deducted here. And then you come at the bottom, you have your estimated cash to close at the bottom. So like I said, this is the total amount that you're going to pay for this house, at least down payment, your total cash to close to buy the house. Okay, last thing we're going to go through is just the loan process from start to finish. So you want to buy a house, what happens and when? So it starts with the first thing you do is you get pre-approved. Now, this is before you even call a realtor. Everybody calls a realtor, and that's the first thing they do. And every good realtor, when you call them and you say you want to look at a house, the first thing they say is, are you pre-approved? Right? And so you need to get pre-approved first. So pre-approved is where you go to a lender and actually, I'm not going to get too far into this because I've got a whole nother video about pre-approvals that we're going to get into after this. So pre-approval is first, and then once you're pre-approved, then you go house shopping. That's when you call your realtor and you tell them what you're looking for. I'm looking for a 3-bed, 2-bath ranch with a 2-car garage and a white picket fence, in this school district, right? And so your realtor goes and finds houses that meet your criteria, and you basically go and look at houses. This is the fun part, right? You're looking at all these different houses and everything, and putting in an offer on a house. So next, after you've put in an offer on your dream house and it gets accepted, if you have an accepted offer, you are now under contract. And this is where everything happens. So typically the time frame from the time that you sign the contract to the time that you close the loan is about 30 days. And all the rest of the stuff happens in that 30 days. It is action-packed. So the first thing is, first off, tell your lender as soon as you have an accepted contract, because they need to get started on all of this other stuff, right? So the first thing is they're going to send the initial loan disclosures, which is going to include that loan estimate that we showed you earlier. That's going to be in there that kind of shows you the terms of the mortgage loan. And then once that's done, then your loan goes into processing. And processing is basically collecting all the documents. They're going to need all kinds of stuff from you. They're going to need letters of explanation for different things. They're going to need pay stubs and W-2s and tax returns and bank statements and all kinds of different things. They're going to order the appraisal. They're going to order the title work. They're going to order homeowners insurance, all kinds of different things. And then you have appeals and inspections. When you're under contract, the first typically like 10 days are like the inspections period where you can get a home inspection. And home inspections are not required for any loan type, but they are recommended for first-time home buyers because you want to make sure that that house is safe, that there aren't issues that you are going to be a problem later, like a foundation, or maybe the HVAC is really bad, or who knows. So that's the time frame that you want to get those inspections done, and make sure that the house is solid and everything. And then you go through underwriting. So the underwriting is basically where the underwriter is someone that works for the lender that is going to look at all the documents. They're going to look at the appraisal. They're going to look at the title work. They're going to look at your income documents, your asset documents, your credit report, everything, and make sure that everything meets the lender's requirements, right? And then once that's done, then you are what's called clear to close, final approval. Once you're clear to close, that means the underwriter has given their stamp of approval. We are ready to go. We are ready to close on this loan. So then they're going to send you your closing disclosure, which is going to be another form similar to the loan estimate, but this time it's all the final figures. So the loan estimate, a lot of those numbers are still estimates, but the closing disclosure is like the final version, everything's solid. This is the true number that you need to bring to closing. And then there's a wait period. So closing disclosures have to be sent out and signed at least 3 days before you can close. All right. So they're always going to try to get that closing disclosure out at least 3 days before closing. And then after that, they're going to draw up the rest of the closing documents. When you go to the closing table, you're going to sign like 80 pages worth of stuff, and they have to get all that stuff together. And then that's the end. Once you get to the closing table, you sign 80 pages worth of documents, you give them the big check, and then you get the keys. And now you have a home. And there you go. So that is the process in a nutshell. Next up, we're going to be talking about pre-approvals. What does it take to get pre-approved? What do lenders look for? So stay tuned for that, and good luck buying a house. Thanks.